A very simple, validated, and tested no-nonsense Forex trading strategy that works. No cap. What's going on, traders? My name is Dillon and welcome to a brand new playlist for this YouTube channel, which is the best trading strategy series. So I'm super hyped to get started on this brand new series, so let's get straight into it. Okay, so super quickly, I just want to introduce what this new series on this YouTube channel is going to talk about and what the purpose of it is. Now, there is something that I have noticed recently that I see a lot of on YouTube, which follows the following criteria: high win rate, high profitability, and somewhere in the title it has best trading strategy. But going through a lot of these videos, there is something that I have noticed, and I can see a little bit of a trend happening. And these are as follows: low sample size, cherry-picked currency pairs or assets that work for that particular trading strategy, and finally cherry-picked charts where this particular trading strategy happened to work. Now, if you are familiar with trading, you would understand that testing a particular trading strategy is very, very important before actually going out and trading it. And that is why before you put your actual money on board, you need to test these things out. So the idea of this best trading strategy series for this YouTube channel is to do all the hard work for you, and is to actually test and validate a lot of these common trading strategies that I have seen on YouTube to actually see whether they work. And that is to test them over a long period of time, over a variety of currency pairs or assets, to hopefully get a large enough sample size. Because if you know me, you know that I like to take a quantitative approach to trading, so that is exactly what we are going to be doing. So the very first trading strategy that we are going to be testing for this YouTube series is, of course, a no-nonsense Forex trading strategy. You probably guessed that because it was already in the title of this video anyway. No surprise. And the good thing about this trading strategy is it is extremely simple, and it is going to be tested across all 28 currency pairs over a long period of time. In fact, this is one of my very first trading strategies. When I have tested it, it looked very, very promising, and I am going to be sharing that with you today. So this is what it is. We're using 3 indicators, and they are very common indicators in the No-Nonsense Forex community, and they are the SSL, DPO, and WAE. WAE stands for Wada Explosion, I think. Forgive me if I pronounced that wrong. So we enter a long trade when our SSL 12 is crossing over, whilst we also have our DPO 20, which is positive, and our WAE 70 is above the signal line. Likewise for shorts, we are entering when our SSL 12 has crossed under, whilst our DPO 20 is below 0 and our WAE is above the signal line. Also, we are going to be taking into account the 1 candle rule, and we'll be setting our money management to, of course, the no-nonsense Forex money management, and that is our stop loss at 1.5 times ATR and our take profit at 1 times ATR, only taking half the trade off, and the other half is trailed at 1.5 times ATR as soon as our first trade takes profit. And that is a slight tweak to the trailing stop loss method of No Nonsense Forex, something that's a little bit more simpler. Now, if you're not 100% across the no-nonsense Forex trading system and what those little nuances or money management systems are, then I would, of course, leave a link in the description below so you can go check out No-Nonsense Forex, because there is a lot of good value in there. Now, as I mentioned, if you've been following No Nonsense Forex and you've been a part of the community, you would know that these indicators are fairly common. In fact, the SSL was actually recommended by the No Nonsense Forex creator himself, VP. And on the other side, you would also have noticed that half of the No Nonsense Forex trading strategy is actually missing. As I mentioned, this is a very simple No Nonsense Forex trading strategy, and it's also here to demonstrate to you that you don't need the bee's knees and you don't need everything in the No Nonsense Forex trading strategy to actually get you up and running and to get a strategy together. It's often best if you start off small, start off with something simple, just to get your foot in the door and just just to get you trading some sort of trading strategy that looks promising in the future. So that's exactly what we're going to be looking at today. Now, with any scientific approach, whether that be quantitative or qualitative, we need to look at the methodology. And if you remember high school science, this is actually very, very important to do. And this is something that I'm going to be carrying over in every single episode of this video series, because if we are going to be taking a scientific approach to our trading systems, then we of course need to have the appropriate methodology and testing regime in place. And that's where I want to be 100% transparent with you. And that is why we need to have a particular testing methodology every single time we do test a trading system. So in today's video, this is the methodology that we are going to be doing. So of course, first thing is we need to develop a code for this trading system. And of course, if you know me, you followed my YouTube channel, you know I like to use TradingView. It's nice and easy, it's simple. In fact, I did a whole series on YouTube on how to code the No Nonsense Forex trading strategy. And just as a little hint, this code is somewhat related to that video series. So first step, develop the code. The next thing we need to tick off is we need to make sure that we are testing our trading strategy over all 28 major Forex currency pairs. And that is to ensure that we have a diverse range of Forex assets that we are testing on. And that also helps with sample size. And because I mentioned sample size, the next thing that we are going to tick off is we are actually going to be testing this trading strategy from 2004 to 2016. And this will show a very diverse range of different market regimes over this period of time. So we're going to get a gauge of a lot of different market regimes. Now, the next thing is this particular trading strategy is optimized, and this trading strategy is optimizing the SSL period, the DPO period, and finally the WAE sensitivity. The one candle rule and the No Nonsense Forex money management that I did mention, those have not been optimized, and those are consistent over every single test that we do. So in theory, we are only optimizing 3 parameters, and that is 1 parameter for each one of our indicators. And just as one thing to note, that is going to be our in-sample test between 2004 to 2016 over all 28 pairs. And now finally, we are going to do an outer sample test or a forward test on this trading strategy after optimization between 2016 to the start of 2021. And the reason for this is we want to test our trading strategy on data that it hasn't seen before in the past to make sure that it is working properly and that it doesn't show any signs of curve fitting or over optimization. Ideally, we want to have very similar results in terms of ROI and drawdown between our in-sample and our out-of-sample testing. So that is the methodology that we are going to be using today. And of course, I have already done this. So let's have a look at the results. So this is the raw data of our trading strategy, which we are going to go through today. And just to quickly mention that this is the data from the start of 2004 to the start of 2021. So a long period of time with a lot of different market regimes, and of course across all 28 currency pairs. And as I mentioned before, we do have an in-sample and out-of-sample test because we have optimized this trading strategy. Now, just to quickly go through this spreadsheet, which I will provide in my Discord. So of course, if you're not a part of my Discord, there's going to be a link in the description below for you to go check it out. So we can see here in column B, which is this one here, I have all of our 28 currency pairs, which are color coded to the best performing pair to the least performing pair. And you can see that there is a lot of positives rather than negatives if you look at the values here. So straight off the bat, it does look fairly promising. Now, I haven't factored in commissions, which is something that I do need to mention. However, I don't think it would matter too much, particularly for a trading strategy that is traded only on the daily chart. However, if you did want to validate this trading strategy with commissions, then I would highly recommend you do so. Now, the last thing that I want to quickly mention is on the right-hand side, we do have the win-loss ratio for all currency pairs. And down the bottom, we do have the totals and the averages for these particular metrics for all 28 currency pairs. And we can see here that for this particular trading strategy, we returned $64,000 over the entire period of time with a win-loss ratio of 0.61. So the strategy is profitable with a fairly decent win-loss ratio. Now, one thing that I need to mention, which I didn't before, which is our account size, and as well as that, our risk per trade. So this particular spreadsheet here that is opened up right now, which is the adjusted risk summary, this has already factored in and adjusted our risk per trade so that way we are factoring in a maximum drawdown of 20%. Now, if you want to see how I've done that, then of course the spreadsheet will show you this, or you can also watch my other videos which talks about adjusting your trading strategy to fit particular metrics like maximum drawdown. So originally, when exporting this data from TradingView, I was using a 2% risk per trade, and that is non-compounding and a fixed amount based on 2% of the starting balance of the account, which was $50,000. So every time we are putting on a trade, we are taking 2% of $50,000, which is $1,000 risk per trade. Now that has been adjusted based on the maximum drawdown of that 2% risk model, so that way we can factor in only a 20% drawdown. Now with that adjustment, if you're familiar with this methodology, we have reduced our account position size by 3.8, so that way in the final trading strategy, we are only risking 0.65% risk per trade. So again, if that really didn't make sense to you, then feel free to watch some of my past videos on adjusting position size. However, the methodology of adjusting your position size doesn't really change in terms of win-loss ratios, and your profitability does scale when we do reduce it. So everything is still valid. So with this current methodology, and whilst risking 0.65% risk per trade, we can see here that we do have a maximum drawdown of 20%. Now we can discuss profitability. Now in total, our profitability, which we can see here on average in total, returns about 7.54% each and every year. Now at first glance, this might not seem the best. However, I'm going to talk about this a little bit more just in a minute. We can see here that I've got our in-sample test as well. And in our in-sample test, which remember, we were optimizing our trading strategy based on our in-sample test, we have an optimized return on investment of 7.92%. And remember, that was between 2004 to 2016. Now, finally, our out-of-sample test, we can see here that we returned 6.62%, which is in the rough ballpark of our in-sample test, which is really good. That means that our trading strategy does seem promising and the outer sample test is validated. And this was 6.62%. And now for me, I think one, it's profitable, and two, it's roughly in the same ballpark as our in-sample test. So that's good to me. So by just looking at the numbers, we can see that this trading strategy actually seems profitable and is actually a decent trading strategy that actually works over a wide range of currency pairs over a long period of time, whilst experiencing a lot of different market regimes, whilst only having a 20% drawdown, which is the rough risk tolerance for a lot of traders out there, I think. Now, before we go any further, I just want to show you the equity curves of this, and the equity curve of this trading strategy looks like this. In the green, we can see that this is the outer sample test. So of course, this is where the trading strategy was not optimized but tested and validated. And on the left hand side, we have the in sample test where the trading strategy and the different parameters were all optimized. Remember, we did only adjust 3 parameters, so that is okay in my opinion. Now, because this is the No Nonsense Forex trading strategy and it is trading the daily chart, we can see here that we do have extended periods of times where it does plateau a bit, and that is probably because the market regime for that period of time, of course, wasn't trending. The No Nonsense Forex trading strategy is a trend following trading strategy. However, when markets do trend, we can see a very big increase in the equity curve. And this is what, of course, we want to see. Even though we are plateauing over here, that plateau is actually a very good thing, and it's not really signifying a drastic drawdown, unlike this period here. Of course, there's going to be losing periods. There's going to be periods where a trend following system does not work. However, in the long term, we can see, particularly with Forex, this trading strategy does work quite well. And this is something that I want to distinguish, unlike a lot of, for example, long only trading strategies for stocks, which stocks have generally always gone up.
Stocks only go up.
This is Forex, and Forex sometimes can be very unpredictable, as they are just ratios between currencies, unlike stocks, where stocks only go up.
The stock market's not doing great right now.
Now on the right hand side, although to the naked eye it does look fairly flat, it does show a steady growth, and that of course was validated in our ROI for our outer sample test. So even though it does look flat, if you do run a regression line through that, or even if you look at it just a little bit more, you can see that it is a trend up. Now, the last thing that we do have on this spreadsheet is our maximum drawdown graph. And we can see here that what this is plotting is, of course, our maximum drawdown over these periods of times. And we can see that our outer sample test actually didn't have our biggest drawdown, but our biggest drawdown was shown in our in-sample test. Now, remember, we did adjust our drawdown based on a 20% risk tolerance. So our maximum drawdown over here was this period, which was $10,000 or 20% of our equity. Remember, this is non-compounded, so that means that over time, as our equity does increase, our dollar value of our drawdown will increase. However, that also means that our dollar value of our equity curve will also be in a parabolic nature, so it might actually look a little bit nicer than this. Now, the last thing that I just want to raise, and I mentioned that I'll come back to this, is our ROI. So at a glance, we can see here that our ROI for our total is 7.54%. Now, a lot of people in trading, and the goal for most traders is to beat the S&P 500 over a long period of time. Now, on average, the S&P 500 has returned roughly 10% each and every year. Now, that average might go up a little bit if we do weigh in what's happened in the past year. Thank you, Jerome, for those tendies. However, that's notwithstanding that over a long period of time, the S&P does generally return about 10%, and the goal is to hopefully beat that 10%. Now, of course, at a glance, our trading strategy doesn't beat that. We have a 7.54% return on investment for our trading strategy, where we want to see something that's around 10 or more. However, as I mentioned, we can adjust our trading strategy and up the risk a little bit if we desire. And as well as that, I've mentioned in past videos, we need to look at both profitability and the losses as well. And this is what I don't see a lot of traders actually talk about either when it comes to strategy development and comparing trading strategies as a whole. So if we look at the S&P 500, we can also see that although the S&P 500 does return at 10% each and every year on average, it also generally has about a 20 to 30% drawdown, and that is something that is very common when it comes to following the S&P. And let's take, for example, the 2008 global financial crisis. That was a 37.47% drawdown from peak to trough, and that is something that is, of course, past a lot of people's risk tolerance, particularly if you were a trader. However, let's just say, for example, that we factor in the same drawdown as the 2008 GFC crisis, and that was, as I mentioned, a 37%. So I can adjust this over here in this column and put our maximum drawdown allowance as 37. So just like magic, everything has adjusted, and let's just say that for our particular trading strategy, our risk tolerance was 37%. Now, because our risk tolerance has increased, that also means that our position size can increase, which of course increases our profitability. And we can see that now in total, because we are increasing our position size every time we trade, although our drawdown does go up because our risk tolerance has increased, our ROI does go up as well. And that ROI is now 13.94%. And there you go, chicken tendies. We have a trading strategy that is proven to beat the S&P 500 over a long period of time. That's pretty cool. And that is the trading strategy, and that shows that even with a basic no nonsense forex trading strategy, we can actually beat the S&P 500 when adjusting our position size appropriately and comparing both return on investment and maximum drawdown of both our trading strategy and the S&P. However, there are some things that I want to talk about which are some fruit for thought, and that is, of course, we have tested this trading strategy over an extended period of time between 2004 to 2021. Now, as we've seen through the equity curve, this trading system will perform well over a long period of time. However, of course, it performs the best in a trending market, of course, being a trend following system. Now, you can develop multiple different trading strategies and turn this trading strategy on only when the trending regime is there. And then maybe you can turn on different trading strategies or an adjusted strategy when the trending market may not be there. There is, of course, as I mentioned, other things that you may need to take into account, just like commissions as well as slippage. And when you are coding your trading strategy, you can account for that as well. However, I think that that might be slightly negligible. And another thing is, and something for you to consider when it comes to quantitative trading, this trading strategy performs okay over an extended period of time. However, something that you might want to consider is, instead of mitigating our overfitting risk, which is increasing our sample size, which is testing our strategy over a long period of time, something that might be beneficial is taking some underfitting risk and actually now perform one final optimization or test over the last, for example, 3 to 5 years. So we are now testing and optimizing our trading strategy on more recent data. Now, of course, being a daily traded chart and only looking at 3 to 5 years of data, we are not going to get a very adequate sample size. However, it might be beneficial and it might be worth taking some underfitting risk, taking a small amount of sample size to actually test and optimize your trading strategy in more recent data. And that is something that you can consider, which that way your trading strategy is now optimized for the most recent market conditions, and maybe you can extract a little bit more edge out of the market. However, those are just some things that come to mind that you might want to consider. Saying that, the purpose of this video is to demonstrate that this particular trading strategy works over a long period of time, and that is tested and validated using, in my opinion, and the best of my ability at my current stage of quantitative trading. It is tested and validated appropriately using in-sample, out-of-sample data over all 28 pairs over an extended period of time. Not only that, but I've also shown you the pairs that it does work and the pairs that it doesn't work, and I haven't cherry-picked anything, and it's something that I am going to, as I mentioned, provide to you in the Discord link down below. And one final thing is, if there is anything that I have missed, if you are a quantitative trader yourself out there and you want to critique this work, please reach out to me. I would love to get some constructive criticism, or if there's something that you've picked up on that might be beneficial to actually incorporate, please reach out to me, and I can also do a follow-up video to actually see if I got anything wrong, or maybe even improve a couple of things. I think that would be really good to see. So that is the end of the very first episode of the best trading strategy series, where we actually quantify trading strategies out there to see if they work or if they don't. Of course, the very first one is a no nonsense forex trading strategy, which I did develop and optimize myself. It's actually using very common indicators, but I've shared with you the methodology of how I've optimized this trading strategy and validated it to make sure that it does work. So if you did like this video, then please give me a thumbs up, consider subscribing if you haven't already, and of course hit those bell notification buttons so you can stay up to date when I do release the next one. If you got any comments, or if you want to see another trading strategy be tested, then please reach out to me in the comment section below or in my Discord channel. It'd be really cool to get a gauge on what you all want to see. Saying that, I do hope you enjoyed this video, as I mentioned already. Have a great day, happy trading, and I'll catch you in the next episode.